When choosing to buy or hold investments, it always makes sense to take a view on how the world's travelling. Nothing stays the same forever. And at Middletons, we look at a number of different investment themes and for ways our clients could either profit from them or avoid losing money as a result of them. There are 5 of these themes we're talking about this year. The first theme is all to do with share market valuations. The path ahead could well be a little bit tricky. How do you know if shares are expensive or cheap? Well, traditionally, shares have been valued as a multiple of profit or earnings. The multiple is called the price to earnings ratio, or the PE for short. The median PE for US shares over the past 60 years has been 16.5, and that compares to the PE ratio at the end of November 2013 of just on 17. By this measure, shares in the USA, despite strong recent performance, are at about average value. You can also look at the earnings yield. This is the inverse of the PE ratio. In other words, it's the amount of profit in percentage terms you're getting for each dollar that you invest. The median earnings yield for US shares over the past 60 years has been 6.1. This compares to the average long-term interest rates over the same period of 5.8%, and that's pretty close. The chart shows the earnings yield of US shares compared to interest rates since 1954, and it also shows the median for both over the same period, the red line. When the earnings yield, the blue line, is above the red line, shares are cheap. In other words, you're buying profit at a lower price than you normally would. But you'll notice a much higher correlation between the earnings yield and prevailing interest rates, the green line, than with the long-term average. The reason's kind of obvious. If interest rates are high, you'll be looking for a higher earnings yield from shares, and the only way you'll get this is by paying less for them. So shares through the 1970s and the 1980s appear cheap compared to the long-term average, but they're not cheap compared to the prevailing interest rates. Shares are actually expensive when the blue line is below the green line, as it was in 1972, 1982, 1987, 1991, and 1999, and all of these were very difficult periods for the share market. At the end of November, the earnings yield, and therefore the PE, of the US shares is close to the long-term median, and with interest rates very low, US shares look cheap in comparison. In Australia, the market splits into resource stocks and industrials. The values of resource stocks move to their own rhythm, but industrial shares in Australia behave in much the same way as US shares. We've got historic data for the industrial shares currently in the top 50 shares in Australia, and the chart shows the average earnings yield for these shares compared to interest rates on 10-year Treasury bonds. Coming together after the recession of the early 1990s, the earnings yield of large Australian industrials was in lockstep with long-term interest rates until the GFC came along in 2008. Interest rates fell and so did share prices, causing the earnings yield to increase because share prices fell by more than profits did. The current earnings yield for industrial shares is 6.2, a PE of 16.1, indicating that Australian shares are around fair value. This chart shows the long-term average earnings per share for these large industrial companies against the average share price over the last 23 years. It also shows the average anticipated earnings based on analysts' projections through to June 2015. When the red price line is above the blue earnings line, prices are above long-term valuations and vice versa. The risk is that if long-term interest rates stay low for an extended period, they will cause the price of shares here and overseas to go up by more than they should. It goes like this. I can get more income from shares than I can get from term deposits, so why would I own term deposits? People will pay more for shares until the yield from shares stops being attractive compared to term deposits. So far, investors in the USA and Australia have resisted doing this, and that's good. This wasn't the case before in residential property markets in the USA and Europe, where easy access to money and low interest rates caused property speculation that eventually triggered the global financial crisis. If we see a bubble in share prices due to low interest rates, then there'll be a crash when interest rates go back up, and it could be ugly. For example, if share prices increase so the earnings yield from Australian shares goes down to 4%, then share prices would have to go up by 35%. This part's fun and it'd be a shame to miss out. But then, if interest rates return to the long-term average of 6%, share prices could drop by 35%, and that would be no fun at all. When it comes to discussing the world economy, the biggest problem we face is the currently high level of government or sovereign debt. The level of sovereign debt was virtually steady before the global financial crisis, but to avert disaster, the governments of the USA and Europe have taken a huge amount of private debt onto the public balance sheet, and now we have a big problem. For normal people, there are only two ways to reduce debt. You either go into bankruptcy or you pay it back. Governments don't want to do either, so fortunately for them, there's another way. The process is called financial repression, and it's worked before. You just need a bit of inflation to erode the value of the debts in real terms. You need to keep bond interest rates below the rate of inflation, and then you need to require people to own bonds and control the flow of capital. This last bit may be a bit more difficult these days, although there are plenty of investment mandates that require government bonds, and they're seen as the only option for a low-risk return. Perhaps instead you can have the central bank stand in the market and buy the bonds to get a similar result. You're printing money to get inflation happening and keeping interest rates down at the same time. At the end of the Second World War, many countries had debt levels compared to GDP that were much higher than they are today, and by using financial or fiscal repression, the issue was largely dealt with within 10 years. The analysis of Harvard's Professor Carmen Reinhart suggests that without financial repression, the situation would have become worse. You might have heard the old joke about the overweight person who tried everything to lose weight short of dieting and exercise. Well, the governments of the world would like to get out of debt troubles without default, without hyperinflation, without comprehensive austerity, and without increasing taxes. Financial repression is the answer. It's worked before. You just get the savers of the world to pay the price in the form of negative real returns, and the best thing is they may not even notice. There's been plenty of commentary over the past 10 years about emerging economies, but the reality is the emerging economies have already emerged. The green areas are the United States, Europe, and other developed countries, including Australia. And while these economies have been growing over the past 20 years, the BRIC economies of Brazil, Russia, India, and China, and the other emerging economies have been growing faster. These emerging economies were only 38% of the world economy 20 years ago, now they're 54%, and by 2018 they'll be almost 60%, measured in purchasing power parity. For China, it'll become difficult to be regarded as the most important country on earth while your currency is linked to the value of another. At some point, the renminbi will float and probably appreciate. At some point, the Shanghai stock market will become one of the largest and most significant markets in the world. By then, it'll be too late to do really well, so how are you going to take a position and benefit from this undeniable reality? Turning our attention to matters domestic, I'm pleased to tell you that the minerals boom isn't over. The developing world still wants lots of everything, lots of iron ore and coal and other raw materials. Going back 10 years, they wanted a lot of everything and the supply was simply not available. When that's the case, the high demand bids up the price of raw materials, and it becomes very attractive to invest in new mines and also into the infrastructure to get the raw materials to the ports in larger quantities. At its peak, the construction of mines and mining infrastructure grew to be 18% of the Australian economy. It wasn't just happening here. Spending happened all around the world, and the supply of raw materials increased substantially. Even though demand remains high, commodity prices have come down and could well come down further. So now it isn't as attractive to build more mines or infrastructure, and construction is winding down. In the next year or so, mining and infrastructure building will account for only 3% of the economy. The construction phase is effectively over. This construction phase was the basis of our miracle economy. It wasn't our national brilliance or the brilliance of our politicians or our bankers or our regulators. They're all fine, but it wasn't them and it wasn't us. Nor is there any easy way to replace the economic activity that's disappearing. The Australian economy looks set to go through a period of slower economic growth until a replacement for this economic activity is found. It probably won't come from a resurgence in manufacturing. The closure of the Ford and Holden manufacturing operations are examples of why not. Our currency has been very high because of high commodity prices, and as the high prices retreat, so does the value of our currency. This will help make Australia more competitive, but it isn't just the dollar. Our wage structures are much too high to compete, and our volumes are much too low to get economies of scale. If you want to compete, you have to be prepared to work for wages paid elsewhere, and no one wants their personal income to fall by more than half. There will always be manufacturing, some of it specifically for the Australian market and some of it niche products for a world market, but it's unlikely that manufacturing holds the key to Australia's economic future. Hospitality and tourism offer some opportunities. A lower Australian dollar will make inbound tourism more competitive and outbound tourism more expensive. More tourists will come from overseas and Australians will be more inclined to holiday at home. Rising living standards in Indonesia and China will provide new sources of tourists to fill our hotels, restaurants and resorts. Much is also expected of the building industry. There's a popular view that we're building less houses than we need for our growing population, although there's some debate about whether this is true or not. If there was an oversupply of housing, you'd expect to notice softer house prices than we're currently witnessing, and certainly vacancy levels are quite low, favouring landlords over tenants. It's true that the amount of housing will need to grow at a faster rate than the population due to demographic changes. There are now only slightly more than half the number of people per occupied dwelling in Australia as there were 100 years ago. People started having smaller families. From the early 1970s, the baby boomer generation moved into their own household formation, and the population of adults grew in relation to the number of children. The fastest growing segment of the housing market now is for sole occupancy. Half of the organic growth in our population is made up of people over the age of 75, and in that group the average is less than 1.5 people per house. Governments could play a part in encouraging the building industry. Forget mining taxes, residential housing construction is one of the most taxed activities in the Australian economy. The Housing Industry Association estimates that state and local government taxes and charges add more than $100,000 to the total cost of a new house in a greenfield development, and more than $50,000 to the building cost in an infill development. Savings of these magnitudes could see considerable additional demand for new homes and address some of the social issues involved with young people being unable to move into home ownership. The building industry is widely expected to grow and replace some of the economic activity vacated by mining development. It won't happen overnight, but there are many reasons to be confident that Australia's economic growth will be back to normal levels in the next few years. The final theme we want to talk about also relates to matters at home. The government has changed. Investment markets are often uncertain prior to elections, and regardless of the outcome, it's best to get them out of the way. There are many policies of both political parties that different people will find attractive, but the purpose of this report is to consider only the investment implications of a change of government. This report isn't about social equity, human rights or environmental responsibility, all of which are important. From an investment perspective, the recent change of government will change the direction of government policy in many ways that will impact investors. There were several changes intended to the superannuation system that will now not proceed. This will be good news to high income earners, and those with substantial amounts in superannuation will continue to benefit from the generous tax concessions involved. The new government will apparently be less likely to provide financial support to individual industries, as seen recently with General Motors Holden. They give the strong impression that they'll be more abstemious generally, placing a greater emphasis on saving money than on building social infrastructure. Last year we talked of the risk of our own homegrown fiscal cliff, with both parties aiming to achieve a budget surplus quickly. Since the election, the timetable for achieving a surplus has been extended, and this should avoid unpleasant fiscal shocks. The removal of the carbon tax will assist every small business in Australia to varying degrees. The really big businesses were compensated for the tax impost, but all the small businesses had to absorb the cost themselves. This should improve the outlook for small business and help them pick up some of the slack in the flagging economy. The Mineral Resources Rents Tax was directly responsible for the shelving of billions of dollars of new mining projects. Its removal can bring a lot of those projects back onto the back burner, but in many cases the available capital has been deployed in other parts of the world, and new capital will have to be raised, saved or released from other projects before shelved projects can proceed. The immediate financial beneficiaries of the removal of the carbon tax will be those businesses that were going to be subject to growing taxes in the future, and the major mining companies are the significant beneficiaries of the removal of the mining resources rent tax. The key thing about investing is to look for earnings growth, and thinking about these investment themes will help you do just that, or it could help you avoid some potential dangers. If you look back over the themes, they all have one thing in common. Their underlying reality seems to be undeniable. The themes will make a difference, only the extent of the difference is uncertain. You may have your own ideas, and we can tell you that just thinking about investment themes is a really valuable thing to do. The key is to embrace change, and to do well, you should team up with advisors who are trying to do just that.